uranium is still my biggest position. It's crazy simple when you kind of back it out and have some patience. The main factor is we've just seen oil consumption keep going higher and higher. That's why I'm bullish coal. There's no real capex or investment going into the sector, and it just keeps setting record highs in consumption. So yeah, between coal and offshore, I think that's probably where the most value is right now. I think uranium will do something silly because it's essential. You're going to have to leave the game early. You're going to have to miss some of the fun, but that's the only way you exit and you get home like on time, like safely.
How's it going, everybody? My name is Antonio, and I'm back for some resource talks today with Fergus Cullen, also known as Trader Ferg on Twitter. He's not here with us today, though, as your financial advisor. This is going to be a general and impersonal conversation between basically two talking heads who you shouldn't trust blindly. We're going to be discussing high-risk speculations and obviously make forward-looking statements and guesses about future events that may or may not happen. And if you decide to use those or anything else in this video as investment advice or any type of professional advice, even if it's marriage advice, you will lose all of your money and most of your brain cells. And trust me, that's not as fun as it sounds. Those investments, or better said, speculations, are definitely not for everybody. So you have to, first of all, think for yourself and also speak to a licensed professional about your personal risk appetite before deciding where your money goes. And just, be a grown person, take your own decisions, and carry your own consequences. All right, that all said, Ferg here is, he's trading full-time, mostly energy stuff. He's also raising a baby. He's into Brazilian Jiu-Jitsu and as well as doing a bunch of content on YouTube, his own Substack, and of course on Twitter. So I guess most of all, Ferg, I just want to know how you're still awake at 4 p.m.
With the baby, there's definitely more naps. I recently bought that chair. I call that chair my siesta chair. So when went through the store to buy it, I was just walking around lining chairs and seeing which I could see myself having the quickest nap. So yeah, draw the curtains, hide from the wife, and pretend I'm working and jump in that chair and pass out for an hour. That's the secret of a baby.
Well, I heard that recently from
Thank you
someone
for
else. Yeah, I heard that from someone else who told me that you basically have to sleep when the baby sleeps. Otherwise, there's no other option for getting any decent amount of sleep.
Yeah, in the first few months, he's good now. Like I generally just one wake up during the night, and so it's usually 3 or 4 a.m. Just sleepwalk, shove a bottle of milk in him, and then hopefully downs it in about 15 minutes and passes out again, and that's the duty. So it's not actually that bad. Yeah, the first 3 months was rough, and now 8 months in, he's far easier.
Nice. Well, I'm not gonna say I understand because I still don't, and I'm enjoying every second of not understanding any of that. Jokes aside, thank you for taking the time to chat to me. There's really 4 notes that I made. Well, actually 5. There's 5 notes that I made about stuff that I wanted to talk to you about today, and it's basically uranium, oil, and coal. And most of all, I guess your exiting strategy for the energy trade as a whole. You tweeted something recently, and then that you wrote about the monkey trap, I believe, a couple of years ago. So we're due an update. But I just want to talk about the sort of, if you will, geopolitics or China, which all 3 of the commodities I mentioned here are pretty much dependent on China for a big part, which according to MSM, mainstream media, is about, China is about to disappear into a third world country or not. So I don't know, where do you want to start?
Yeah, we can start with China, and then probably the best follow on there is coal. It's okay. Just China's fascinating because I even got sucked in this a bit, in that just like it was a continual barrage of negative news through all the media, and just China's about to implode. Like and it wasn't until pretty much my go-to person for understanding what's going on in China is a guy called Louis Vincent Garb. He's got a research shop that's based in Beijing, so he's been there most of his career. They've got a good finger on the pulse with the Chinese economy, and he wrote a great piece that was just essentially saying the one that's in trouble is the US, and it's the mainstream media is just trying to do the magical trick of like, look over here, this is where you need to be worried, and backs it up with just a whole lot of charts. Like if China was in trouble, you'd be seeing like their banking sector rolling over. Instead, it's the US that's been getting hammered. You'd see whether everything from property to their tech stocks to the commodities, their imports. It's none of it is suggesting they're in trouble. Yes, they've slowed down a bit, but they were never going to maintain that breakneck speed, because a lot of why they were always aiming for the high sort of GDP growth was largely sort of for job creation. So for decades there, it was kind of a rule of thumb. If they were targeting that 8-ish% sort of GDP growth, then they'd create sort of in the order of 20 million jobs, and that was what they needed to do to kind of keep social stability. And now their demographics are really rolled over, and within the next few years, that trend's really flipping. They'll be sort of losing sort of 8 to 10 million jobs, and yeah, forget what the metric was, whether that's over what time frame, but it's essentially flipped. You can Google any sort of Chinese demographics, and you'll see how it's flipped over. And so they can sort of accept a slower growth, and doesn't necessarily mean there's going to be a big bust. It's which is all we hear in the media. Like you can the old sort of magazine indicator. You can look at any, whether it's the Economist or any of these. There's just been constant sort of China bashing on the covers, and as I say, like none of it's been illustrated by the markets. And if anything, the one that looks to be more in trouble is the US, which is just over indebted, needs to find buyers for the treasuries moving forward that don't. Big question marks of where that's going to come from, especially now that a lot of the sort of Eastern countries, which will be like a topic we'll touch on a few times, there's this sort of polarization between the two of them, like China and Saudi are now getting into bed together. Obviously, Russia's in that. India is largely sort of siding that, and that sort of feeds into coal, I guess. If we start there, the news that I've almost seen no one mention is, I think it was yesterday, the day before, India announced that it's going to add 40% to its coal consumption. And this is as of only, I think it was only not even a year ago, they were supposedly going to start closing down coal plants, and now they're going to add an additional 40% to what they were already building, and that's just monstrous. And it's interesting, if you type it into Google, there's none of the mainstream sort of media organizations have even touched this, which is kind of fascinating when you're talking about the scale of this. Like I was just trying to even break it down in my own head. So if you're talking adding 25% by sort of 2030 to Indian coal consumption, that would be 292 million tons per year. And to give you an idea, like Indonesia consumes 216 tons a year, Russia's 240. So this is like adding more coal consumption than the next few largest, like obviously there's China, India, and then US. I think US is around mid 400s, and yeah, no one's talking about this. And when you look at what some of their energy ministers are saying, it's fascinating. They similar to China, they just repeat the same line, like we will not damage like our energy security or our growth. And this just comes down to both of them have a quickly growing middle class. So both China and India are going to add over 1 billion people to their middle class over the next sort of 2 decades. And so they have to, all the middle classes is increasing your sort of power consumption per capita. And they've got to keep all those people happy, and they know they're not going to do it with renewables. There's another thing that hasn't been mentioned is both China and India have essentially both now rejected the Paris Agreement. They're just sort of saying, no, we'll do our own thing. We're not going to meet any of your goals. And it's getting no headlines, which is, I find it kind of fascinating that they're just literally India, this is the biggest turn of phase. Like, no, we're not going to phase out anything. I think the headlines a year ago where they were going to phase out something like 80 coal plants, which would have been like 30 million tons, which would have been sort of 3%. And now instead they're adding an extra quarter. And China's kind of in the same boat. I think China's not far behind, or no, might even be a bit more actually. Like I was trying to remember, I think China's building 37 gigawatts and permitted 52 gigawatts. And so, yeah, it's kind of on a similar scale to India. And that's why I'm bullish coal is just there's no real capex or investment going into the sector, and it just keeps setting record highs in consumption. And there's the two big players are building like crazy, and everyone sort of points to it being phased out. Where it's being phased out almost doesn't matter. It's so small in scale.
It's
Sorry, that was a big rant.
No, but it's putting everything beautifully in picture, especially when it comes down to coal. I don't know much about anything, and I know less than anything about coal. There's a few things though that I follow up in the news, as well as the China building thing. I think over the last years or whatever, they've built like the equivalent of about 2 new coal power plants per week. So yeah, that says a whole lot there. Now, and also the 2050 narrative of, oh, we're going to go net zero. Many countries are standing up and are saying, no, the welfare of our population is much more important than your, silly goals that you're setting up in the West. They're also seeing what the West is doing to itself. When I say the West, I mean Western Europe, really. What we're doing to ourselves over here with those goals. And a lot of countries are standing up and saying, no, we're not going to do it. Even last week, something related to it, I don't know if you saw, but the UK pushed the ban on new diesel and petrol vehicles from 2030 to 2035. This is the second time they're pushing it further. It's going to keep happening. There's no way that it just makes no sense. So that's a good point too. Now, but so something else about China and coal that I noticed is that for a while there, when coal was spiking, there was also happened during the period when China wasn't taking any Aussie coal. And so what's happening since not too long ago is that they've restarted importing Aussie coal. And what you're seeing Australia doing, although Australia has its own, woke energy policies, they've started permitting new coal mines because there's now all of a sudden all this, old but then new demand coming back online. And what do you make of that whole dynamic where China is importing Aussie coal again, and how do you think that influences the market?
It's just, again, they're going to need to. I've always said it's not an energy transition; it's an addition, and it's where the extra power can come from to keep up with all this. Not only population growth, like the developing world's going to add 2 billion odd people, so you've got all those additional people requiring energy, and then on top of that, the middle class, which is kind of the idea of, there's just going to be a increase in consumption per person. But with Australia is fascinating because you've got a country that's kind of endowed with all this wealth of coal, and then it's doing its best to screw it up with sort of these sort of woke policies like what we've seen in Queensland. Like there was obviously the royalties got just hiked through the roof, and that's caused the likes of Glencore to just walk away from its thermal coal project. The likes of BHP, that's the reason they're selling Daunia and Blackwater. They've just said this is just made it. We don't want to operate in this environment. They even put out quite an interesting sort of piece that said they're responsible for 10% of all the Queensland government's revenues, and so like essentially don't disincentivize us from investing in Queensland. Like what you've done is really stupid, and that resulted in, I think we're getting his last name. Whether it's his first name or his last name, is named Dick, and he's sort of threatened back with like, I'll revoke some of your mining licenses. So it kind of went full banana state, banana republic.
Yeah.
But then that actually was beneficial because then the New South Wales, they sort of had it coming up as well. I was kind of concerned that they were going to follow Queensland's lead and decide to just go with silly sort of 30% royalties as well. And they were quite reasonable. They hiked it sort of 2.5%, and are obviously aware of the sort of significance of it, of incentivizing sort of capital, because it's quite important with some of the more high energy coal, because it's underground, it's got longer lead times, it's more capex intensive, and so you can't sort of chase away the investment. It's not like some of the sort of more like sort of Indonesian, where it's more open pit and quicker turnaround. Or it's again this idea that a lot of the places that have, if you look at where a lot of the coal reserves are around the world, a lot of it is kind of getting attacked by SG. Like you've got Colombia, where there's the new political energy minister sort of saying, keep it in the ground, we don't need this. And so that, for one of the big, you got US, where I was just reading before, Michael Bloomberg's devoted 500 million to legal, legally pursue any utility that says they'll expand coal or even natural gas, which is kind of fascinating. And then you got Australia, where I've just gone over what Queensland's done. And then the other big supplier was Russia, which is obviously getting cut off from everywhere. Like EU's cut it off from coal. And so it's fascinating. All the places that could be ramping to meet future demand, they're been held back by the green policies. And so that's why I'm a huge bull, and why I continue to think there's a very long runway for coal. It's always joke it's the only thing that you could see, like something like Newcastle shoot the lights out, and yet capex went down for it. So it's just going to be this long trend of high cash flows, buybacks, dividends, and sort of a lack of reinvestment, lack of supply.
So it's always funny when I talk to someone in real life about these things, and I just bring up coal, and everybody just loses their stuff, especially when you're talking about growth investing or growth at a reasonable price. And you mentioned something like coal, which I don't know much about it, so I just throw it out there. I was like, hey, maybe. And actually, there's one new article that was published on the Financial Times this morning for me. So I guess sort of it's a morning for you, about 4 hours ago. That was talking about India and coal, because I think there is mostly a marketing issue here, because it's very new and modern and cool to write about all those countries expanding their green energy, their solar panel capacity and wind energy capacity, so on and so forth. But what's happening is in this article, the reality that is being described is that the only way for India to grow, or at least for some of the states there, is creating jobs that creates economic growth. And those jobs often come from, with India specifically, steel and cement output, for example. And how do you power all that with energy that's not reliable? Well, you don't. And so that's why they're building more and more coal capacity, and it's just going to keep happening. And that's simply the reality. There's a bunch of people in India, a whole lot of people in India, who are looking to get out of poverty, right? The only way to do that is with these factories. The only way these factories operate is through coal. And India is not the only place in the world that is in a comparable situation. So that only knowing that little already tells you that coal is probably not going away over the next 10 or 20 years or whatever. But then at the same time, I'm wondering, so we know that coal is going to stay around, but what does that mean for the price of coal, as in the level at which it is right now? What is it, 160 or something a ton? Is that a good enough level? Is there an incentive price for new coal mines, or are they making money right now? And does the price really have to move up?
Yeah, one thing I want to touch on just with India as well that I forgot to mention is just the air conditioning demand. It's phenomenal. I've done a piece on that, and that the growth that you get just out of increased percentages of AC across all of Southeast Asia and India is just phenomenal. And it's base load that's required at night. Like renewables don't even fit the sort of demand curve for this. Like if you have something like solar, it's you've got the duck curve, and you have peak production, peak generation during the middle of the day. It just completely is mismatched to all this. And that's something that both Indian and Chinese officials have been touching on, is the fact that there isn't the storage technology to even meet their sort of consumption requirements. And so they're just saying this is just an absolute non-starter for us. And that's also before you go down the fact that what also gets left out of the whole debate with sort of coal is the fact that I've never seen sort of a reasonable projection of how we, like Vaclav Smil calls them the four pillars of sort of modern society. And you've got ammonia, you got steel, you got cement, and you got plastics. And all the green sort of projections are just that we sort of survive on this utopia of wind and solar. But all of those four all require massive amounts of fossil fuels. Like half the world's fed by synthetic ammonia, which is largely a result of Haber-Bosch, which is natural gas, or it can be via coal, which China does. You've got cement, which involves massive amounts of coal. You've got steel, which is massive amounts of met coal. And you've got plastic, which is obviously derivative of oil and gas. And there's never any mention of these. And if anything, Vaclav sort of has a go at the projections by saying your solution to this is almost a tribute to the wonders of oil and gas with a wind turbine. It's just a massive pile of sort of rebar steel, a big steel cylinder, a ton of cement to hold the base down, and then you've got these massive plastic composite blades. It said it's all just fossil fuels, and it's got a relatively short lifespan. And so, yeah, I just wanted to have that slight sort of tangent. But yeah, coming back to your question on coal pricing, I'm heavily positioned for it to go higher. I just think there is a complacency at the moment that we're going to soon see rectified, especially in Europe. Like, I'm very bullish the seaborne market. I think if you have players that have good exposure to seaborne thermal, I think being for a nice run. Even Met, I kind of was questioning why I was bearish on Met. With like, I might have got too sucked into the negative sort of Chinese property story, but they've all been holding up really well. And so, yeah, I just see with that sort of, it's still supply to demand. Like, if you're not adding any supply and everyone's just financially engineering, like trying to think of an example, kind of like what's going on with Whitehaven at the moment. They're saying, like, why the hell are you buying extra mines or even thinking developing when you can just do buybacks? Your stock price is so low, so why not just buy back their own stock and get shouted at by some of the large investors? All that means is that's just going to continue to destroy supply and tighten the whole picture and have higher prices for longer until you fix like the supply side, which, as I've just gone around the world, like with all the sort of, whether it's Colombia, whether it's US, whether it's Canada, whether it's Australia, they're all doing their best to sort of smash the supply side. The result would be higher prices for longer. Yeah.
It's a very good point, because I normally like starting at the supply because I prefer supply-driven thesis. And yeah, you mentioned in Colombia, I read an article just right before this talk as well that their attorney general's office has sent some sort of a note to the president asking to to no longer grant concessions for exploration and development and building and mining of open pit coal mining projects. And then so there's that. But then there's also China. And then there's also red tape so coal mines are generally risky. I mean, a lot of people die in coal mining. And the reason that we've had a relatively stable output of coal is because oftentimes in the past, a lot of these things were ignored. Like, it sounds kind of sad to say, but that was kind of the reality. Like, it's just, if you work in a coal mine, you have a very high risk, relatively high risk of dying, as if you're, versus if you're working in, let's say, a lithium mine or whatever else it might be. And so a bunch of states, China including, since last Monday, are trying to do something about it. What is that going to result in? Well, more red tape and more regulations, as it should. I'm obviously not advocating against it, but that's going to result in, a higher incentive price too, and a potential hit to global supply. I don't know if you also think that, or if I'm mistaken.
Yeah, no, you're correct. It's the one that comes to mind when you talk about that is just there's a lot of bullshit flung around about how we can just import, the West can just suddenly start magically producing some of the commodities that China's monopolized. Like, the perfect example is rare earths. It's a hugely dirty process. It's have sort of radioactive sort of waste as a sort of a byproduct. And if you're going to take that from the Chinese, which also massively subsidize the whole process, so a lot of it's kind of a what do you call it? They're not directly mining it; it's a byproduct. And then from there, they've got no concerns about environmental damage. Like it's a great piece, just showing like the depth toll from it and the amount of damage in the areas that have been devoted to it in China is just enormous. And then when you get up the value chain, they've just subsidized it so heavily that there's no way economically anyone else can compete with it. Like the stat that stayed with me was the fact that they can generally sort of evaluate process, like take iron ore to steel. It's a sort of 400% increase to drive that process, which is obviously the energy requirement, the labor, and what China was doing was converting sort of the rare earth ores into the sort of end products alloys for 10%, which didn't even cover like the energy input. And so it's just the fact that the West sort of thinks it can quickly scale up. And if anything, the most recent examples, Linus, their processing plant in Malaysia. Malaysia's just backhanded them and said, like, we don't want you doing this anymore. They've been having back and forwards for years on it. And now, last I seen, the Malaysians had just said, like, we're banning exporting rare earths. And so that was Linus's only processing plant and the only rare earth processing plant out of China, I believe. And it's using that as sort of an example, this idea that we can just instantly take stuff that the Chinese have been doing, subsidized, super low cost, no environmental concerns, and just bring it over to the West. And even if we can, like, what is the cost going to be when you do it all environmentally friendly, and can you even get it done by the time you sort of fight all the sort of environmental groups and lawyers, like I just mentioned, with like sort of Michael Bloomberg giving them 500 million to fighting anyone wanting to just keep the coal and gas plants running, trying to preemptively shut them all down.
What I kind of don't understand here, though, is the government's reaction to all these things. Like, I'm sure all of us can agree on, okay, we want, safer production of coal. We don't want people dying producing energy for us. But the government's reaction to that is oftentimes like, so if you ask yourself, why is the risk so high? Oftentimes is because, there's cost cutting and a lot of corners get, cut or just a lot of things get ignored because companies want to make more money, oftentimes because the price of what they're selling is relatively low. And so the government's reaction to that is like, let's slap them with more taxes and fines and make it even harder for them to make money. Surely that's going to make them, pay more attention to safety. And it's like the exact opposite. And I mean, if I can understand it with an IQ or with an ED or something, why is the government not understanding any of that?
Yeah, well, I think they're going to have to start understanding it. We're slowly seeing the very start of like the death of the sort of the green projections. I think over the coming winter, you'll probably see this ratchet up a lot. But I've been surprised how many articles have been put up of like the demise of like the wind turbine manufacturers, like the wherever it's Vertas, like raising prices sort of 40% and still running sort of a negative 10% profit margin. You've got Siemens Energy getting cut in half and finding all their huge sort of issues with all the turbines produced. You had, if I forget the name of the other manufacturers, just got up in US and said, unless you sort of let us get out of some of the wind auctions we won, like, we're just going to walk away. And this is all before sort of inflation has really kicked off again. I see the whole sort of wind industry is kind of already dead in the water. It's struggling before I think a lot of the big inflation's coming back, and that's going to require sort of just a realization that some of these kind of call it premature extrapolation, just this idea that you just over extrapolating all this stuff. I'm sure everyone's seen some of the net zero by 2050, which is just
Yeah.
has wind and solar scaling massively, and we won't need sort of coal, gas, and coal, gas, and oil. And yet the realization that look, like wind isn't scaling, solar isn't scaling. There has to be a sort of adult discussion about starting to make sure we start investing in some of the fossil fuels again.
Yeah.
And I think that's going to start occurring hopefully sooner rather than later. Or maybe some of my colleagues have sort of said like more pain's needed. You have to really get punched in the face before politicians will there'll be enough pain that politicians will start pivoting as well. They'll start going with similar to what the Chinese and the Indians are saying. There'll be someone that runs on energy security. They'll call it pro-business, pro-growth, and it'll just be secure whatever cheap energy they can, whether it's coal, whether it's and give people back the standard of living that they were kind of used to.
That's not great. More pain. So,
Nope.
thinking about more pain, I was just thinking, I mean, can it get much worse? And then I was going to say, yeah, it can always get much worse. So seems like your dog agrees with us too. So that's nice. Here's
Yeah, sorry.
Well, don't worry about it. Bring him in. But here's something that I'm wondering though, and it is as to like how do I, I'm seeing this, I'm understanding it. Maybe I don't know. Maybe I just got lucky and I looked into understanding something that maybe most of the world is not understanding. And I agree with your takes and views on fossil fuel and energy. But then I look at how do I invest in that and how do I make money off of that? And I start thinking about like here in Belgium, for example, in the big cities. So let's take Brussels, for example. You have to pay up if you want to enter the city with a diesel vehicle. There's an extra tax to that, and there's diesel vehicles below a certain age. There's a label Euro 5 or whatever that are just not allowed in the city, even if you pay the annual tax. And we're all well aware of the fact that diesel vehicles have better fuel efficiencies. The diesel engines that run on diesel generally last longer. You can drive them 400,000 kilometers. Do a remap or whatever, and then it works as new again. So technically, we should all be driving them and understanding. I guess a lot of people understand that we should, but at the same time, people, including me, are selling their diesel vehicles because we want to function properly in society. We want to go into the city with our cars. So while I understand that energy is needed, and I understand that oil, coal, and so on, they're not going nowhere. I'm also concerned is maybe the right word, if you will, about the stupidity that the officials and oftentimes unelected officials will utilize to make a point or for ideological reasons. So the UK oil and gas taxes come to mind, for example, when thinking about oil and gas companies. And I'm just thinking, how could that play into coal? I mean, how do you factor the risk of higher taxation for your coal investments?
Yeah, it's the biggest concern is the likes of there's a good example, the UK with the sort of 75% tax on oil and gas profits. That's what's made this really hard. Like you've got to the sort of long energy thesis is quite simple. What's hard is to dodge these kind of, whether it's nationalization, whether it's profit taxes, sort of royalty hikes, like I saw in Queensland. Yeah, you said even what we saw in the sort of when prices spiked in the European winter, there was sort of obviously taking all the profits off the utilities that did well. There's a lot to kind of try and front run and get around. Like I've had like a sort of a working thesis for a while now that when things get really bad, you're going to want to be more in the sort of the picks and shovels around a lot of the energy plays rather than in the actual energy plays themselves. Because say it's a lot. It's very easy to go after something that's fixed in place and like an Australian sort of coal mine. Like you can't ship it overseas. You can't sort of pull a sort of a Amazon or not Amazon, sorry, a sort of a Google or a Facebook and sort of have your parent company in Ireland and then your your royalties and Caymans, and then you have this whole, like, you've got this fixed asset and you're going to get smashed with tax. So things get bad enough, they will go after them. So it's definitely something you've got to be very mindful of with coal. And a way I've talked about going around that is having just quite a broad coal basket across a lot of jurisdictions, expecting that probably in a long enough time frame, some especially ones like Australia, where they're just pursuing like silly energy policies, they're just kind of following Germany's lead. They will probably find it hard to keep their hands off like low-hanging fruit, like going after coal profits to help prop up sort of their green energy aspirations. So yeah, but with the picks and shovels idea, it's just go for more service-based companies that won't be as exposed to sort of governments going after them. Like our example is whether it's offshore drillers, whether it's offshore service vehicles, they're spread across the globe. They are essentially a play on the commodity, but they're sort of like a second derivative. They're contracting, you've got utilization, day rates. So it's be far less likely to get sort of profit taxed into the ground in that aspect. And then the other is just go straight with the direct commodity. Like I'm a big bull on buying straight WTI calls just out sort of the 1 to 2 years. I think volatility is low. Still got heavy backwardation now. You can get a lot of bang for your buck in those. So I've been a big fan of them for a while. And that way you cut out a lot of the political risk, you cut out a lot of the operational risk. You don't have to worry about sort of cost inflation. If anything, you benefit from like crazy cost inflation across all the projects. If you just own the direct commodity, you're gonna be hugely benefit from all the producers struggling with costs going up. Yeah, the commodity will be the beneficiary. So I'm a big fan of playing it that way. It's just a pity there's not that many commodities that have, like coal, you can't play out with futures. Uranium, you can't. Uranium futures are too illiquid. So it's nice to sort of theory to do it with everything, but really oil's the only one that you can. Tin you can't do it with futures either. So that would be a lovely trade.
Is there a spot for coal?
No, I see there is they're talking about listing an ETF now, which is interesting.
I saw, yeah. What's that about?
Yeah. Yeah, well, it kind of goes against, I've had a whole framework that if you look back at history, most sort of hated sectors, it nearly marks the top when an ETF gets listed. It's almost an exit point. And now seeing they're talking about a new coal ETF, they're talking about a new offshore oil ETF. And my only kind of explanation for it is there's an absolute bull market in launching ETFs. I've got like a chart that they're just launching ETFs left, right, and like launching them super quickly. It's just every year there's kind of been a massive increase in the amount being launched, and I'm guessing it's ease of launching them. I'm guessing it's reducing cost. I've got to think more into that because I'm actually quite fascinated why that's happening. Like why are they so quick out the gate when historically it was kind of they would leave it until there was obviously a massive demand for it. Like that's why it worked as kind of a contrarian strategy. Is by the time an ETF made sense in what was previously a small sector, it was like the end of the sector's run. But now they're sort of launching them right at the start. Would suggest that the sort of overheads of launching an ETF must have come right down, and they can do it on quite a small like AUM.
But does that maybe have something to do with the internet being a lot more used for sharing and talking about investments, though? Because what I mean by that is that like you have these cohorts, on Twitter, sort of groups of people that talk about one commodity, be it uranium or coal or whatever, and then sometimes I even think like, okay, everybody's bullish on uranium, but everybody's bullish on uranium within my little echo chamber. And sure, it looks like maybe there's like 5,000 people, and that's like a whole lot of people. And I could think about, everybody's bullish, let's maybe launch an ETF. But then in the world, it's still a very small percentage of all investors that really care about these things. And an ETF could still make money. But right now, these people are just more visible as a cohort, as a whole. Maybe it's something to do with that. What do you think?
Yeah, possible. I'm just fascinated that they even thought there would be enough demand for a coal ETF. It can't attract obviously institutional money by default. Like institutions aren't going to invest in a coal ETF. It I would have thought that would be the last ETF that got listed. If anything, the last coal is KOL, literally marked the bottom of the coal market and delisting. It sort of said screw this and dumped and dropped everyone off at the bottom of the whole coal market. Like and that was the bottom when it sort of I think it liquidated its positions. And yeah, I need to come up with a better explanation for why they're listing all so quickly. That's the best I can come up with is they obviously can, the costs are lower and they can do it with far more ease. And if it goes wrong, they have more limited downside. It's more sort of almost a portfolio approach. See which scales and shut the other ones down quickly.
So I'm trying to look up Whitehaven Coal because I know you like that company. And I think you like that. I don't know.
Yeah, I do.
Is there a need to go down the quality trail in coal right now? Because it seems it's pretty out of favor. I mean, the price is rather low, but the companies are not. I mean, the stocks of the companies are not doing bad. So is there a reason to go down the quality trail, or do you really just go for the highest quality, highest cash flow, sort of secure cash flow type of companies?
So a few things to mind with coal were like probably avoid some of the big players like the likes of BHP or any of the big names to get coal exposure. They're trying to get rid of it. They're selling it cheap. They're not. They're trying to convert themselves to ESG friendly sort of to get a higher multiple, and then also avoid the really tiny guys in the coal space because they're just going to have trouble getting permitting, financing, and a lot of these things that spit out cash. The management make some pretty undesirable moves, and so staying in the middle there is kind of where you want to be. And from there, I don't think you can go that wrong if you have sort of good seaborne exposure, like thermal and met seaborne exposure. Like I think the US is in for a bit of a glut with domestic coal, so I wouldn't want just domestic facing coal producers. But overall, with coal, if they do launch quite a broad-based ETF, I think that would be highly attractive. Just you really want to get the sort of the sector move. I think all the big multi-baggers are probably behind us, like the sort of the Peabodys and the Whitehavens back in sort of early 2021. Those sort of coming back to life. They're more going to be sort of grinding out buybacks and dividends. It's going to be more that sort of a trade. It'll be sort of a nice long sort of grind higher is my take. Bar maybe if we get a cold European winter, there's some of the players that have high seaborne exposure could really run again.
Whitehaven Coal has a forward dividend yield of 11%. Is that attainable at the current coal prices, or is that mostly coming from prices of where it was like 400 a ton?
Yeah, I think that's and that's probably backward looking, but they've paused buybacks, so they're still sitting on whatever it is at the moment, 2.7 billion. So it's they can comfortably keep paying that out moving forward, and it's the buybacks that have been paused as they're bidding on Dornier and Blackwater, and so whether they pick them up, and that'll essentially double their production base, and depends how much they pay, I guess, and what the terms of all the deal are. But yeah, pause buybacks, but those dividends should hold up and then obviously come flying back depending on what they pick it up for. I think it'll be hugely accretive either way. And then I think the bottom's pretty much in for both thermal and met. So yeah, you only see that go higher over time.
Okay. I'm trying to look up some of the seaborne coal names that you mentioned, and I'm sorry for being, I guess, uneducated now. But what do you mean? What kind of companies are we talking about here? There's literally no name popping up in my mind when you said that.
Well, I think the rank of seaborne exposure is Fungella, which was a spin out of Anglo American that's got quite a short mine life, sort of 70% cash. So that trades like a call option on sort of TTF gas prices. Then I think from there it's be Whitehaven, then New Hope, and then maybe Peabody, maybe I think it was an Indonesian player as well in there. Console Energy would be in there as well. I think those are um, the highest sort of seaborne thermal. Yeah.
Okay. I gotta love these names, Whitehaven and New Hope, and the names that they're giving them are kind of interesting to me. So you think coal has bottomed? And I think this might be
Yeah.
a good point to sort of switch the conversation to maybe oil as well, because oil is not at a bad price. I mean, nobody's losing money as far as I know right now at $90 oil. Sure, there's a price cap on Russia, but obviously Russia has completely ignored that. There was a news article a couple of days ago. Most of their oil still gets sold above that price cap. China's filled up their reserves at much lower prices. So does oil still have a reason to go up higher than 90, or is this sort of an intermediate term top?
I'd say it continue to grind out. Not to say that it won't bounce around if we see a recession. That's the main thing that everyone's still arguing is there still a recession? How bad will it be? What could that do to sort of how much demand destruction could happen? But I think it was largely priced in, and it doesn't seem to be happening. I was just reading a piece from Bison Interest, Josh Young, and it's recommend everyone go and read it. Just saying that we've seen a lot of similar to talking about China. A lot of the sort of whether it's freight, everything seems to be kind of turning around. A lot of the recessionary expectations are sort of continuing to come down from. I forget how many months ago the Bloomberg indicator sort of hit like 100% chance of a recession, and then now it's hasn't happened. And the main factor is we've just seen oil consumption keep going higher and higher. Everyone's sort of falling over themselves. Like the IEA, I always love how they have their missing barrels that they try and hide out the back just because they screwed up they do it every year. I've got some funny charts that they kind of have to revise their numbers because they constantly underestimate like the S curves and developing countries, sort of like China and India. It's just always revised an extra 1 million barrels higher. I've got one chart where they've done it like 4 years in a row. They missed 1 million barrels of growth, and then they added in the next year, and then they say that's it, won't happen again, and then it happens the next year. They have to revise it, and then they say that's it, and it looks like a step. And so yeah, it's kind of a big issue for a lot of the renewable sort of adoption curves as well, because they were forecasting that we wouldn't hit 105 million barrels a day out till 2030, and we're kind of on target to do it sometime next year. And so that's removed nearly 6 years of runway for supposedly building out sort of EVs, wind and solar projects, and that gap is continuing to open up. Like shale's not coming back. If anything, shale's continuing to roll over. And yeah, I'm a huge bull on oil. I can't get enough exposure, whether it's via the offshore sector or whether it's via WTI calls. I've got no idea short term. Like I always say my conviction level in sort of 6 months, like put it at 30%, but take it out to a year, I'm sort of 50, and take it out longer, I'm up sort of 80, 90%, and I find that trade's super attractive with how cheap a lot of these assets are.
But that's not how YouTube works, Ferg. You're supposed to tell me what's going to happen next month.
Exactly. Yeah. What is the title of this? Uranium's about to go to 500. Like that's the always
exactly. Yeah.
Always got to feed the algorithm. Yeah.
Millionaire trader says uranium's going to 500 next month. There you go. It's oil is an interesting one because I see all these measures being taken on the supply side, right? Oil rig counts falling, I believe, by 8 last week alone. Saudi Arabia extending their cut, Russia extending cuts, so on and so forth. And then so you basically have two things that you can think about here is like, okay, are they trying to push the price up? So are they trying to blow off the top of the price, or are they trying to put in a bottom knowing that there might be demand destruction coming due to a global slowdown? What sort of camp are you in?
I think it's just their own incentives. Ultimately, Saudis seen that, like, I don't, like, I think it's bigger picture of Saudis as well. I don't think they've got the reserves they say they do. And so it makes all the sense in them in the world to sort of maintain their cut and drive prices higher and get a higher value for their remaining reserves. And they need the money. Russia needs the money. It's kind of, it's just straight incentives. They see that this deficit's just opening up, and they're quite happy with it. It's gonna be hugely beneficial for them, and it's gonna heap a lot of pain on the West, which are largely sort of, yeah, especially Europe, like energy importers. I don't know if you saw Russia just banned diesel exports, and so I feel like just kicking off. It's kind of like there's all these little news, like we've always China sort of banning the export of, what was it, germanium and gallium, and now
right.
like Russia, just any pinch point, they'll just wait till they see the West at the maximum sort of vulnerability to it. Like if you look at sort of the diesel inventories globally, that's super low, and then they just cut it off. I think Russia's 11% of sort of global diesel exports, and then they just say shut it off, and they're given no date to restart it again. They're saying it's for their own national security, and it's just fascinating when you look around the world, the amount of actions that are going to be taken in the name of sort of energy security or growth. I think that's going to be the two sort of catchphrases moving forward.
Yeah, I can see that happening, but it's also kind of a lot to wrap my head around. And so what I mean by that is that you have like oil and coal, but both of them have a very deep supply market and a very deep demand market, and that makes it kind of harder for me to understand. So I'm acknowledging my own limitations when I've chosen to go for a uranium heavy exposure, for example, relative to coal and oil, which is that I don't have anything in oil and coal right now, which is probably a mistake that I understand, but I'm also acknowledging my own limitations. So what I mean by that is that uranium in this part of the cycle where it is right now, the demand is just there. Like you don't even have to think about it. There's an inelastic demand for uranium, which is, it just doesn't matter too much because shutting down a nuclear power plant costs you a whole lot more money than paying double the price of uranium what it is right now. So there's just the demand for oil is a lot more elastic than it is for uranium, which makes it more challenging for me, I guess, to understand. I don't think that I have a question around there, but it's just a thought that I'm having.
Well, you're right though in terms of attractiveness. That's why I was always by far ran the heaviest uranium exposure. Uranium is still my biggest position. It's crazy simple when you kind of back it out and have some patience. Like you've got X number of reactors globally, you've got X number of pounds produced. It was secondary supply that had to be worked through, and then as you say, there's no demand destruction. They're price insensitive buyers. And if anything, they're kind of it's underestimated how much they will contract when there's this kind of herd mentality. Like, what was it? Contracting was down in the sort of 30% range a few years leading up to now. Now we're at 65, and as things will kick off, it'll do what it did last cycle and go up to well above 100. They will be falling over themselves, contracting the most at the highest prices. Like I've got a chart from last cycle, and it was they contracted sort of 2-3 times as much at the highest price as they did before. It's like kind of doesn't make sense. It's like nonsensical. But then at the same time, as the likes of Mike Elkin have gone through, they're not incentivized to try and bottom pick, and all they care about is security of supply. They don't want their reactor to go off. And so it's why it's hyper cyclical, and it's why it's so damn attractive. Before you add all the other factors that I love now with the sector, whether it's the sort of east versus west polarization, like you're seeing likes of Russia hoovering up a lot of the Kazatomprom, and then talks of like who is it? CNNC talks to them doing a big deal as well to contract a whole lot more Gazprom. And then you've got all the you got the Chinese that they're willing to step in and do what is necessary for their energy security. Take like even recently, like if you look at the LNG market, like the Europeans are kind of tripping over themselves saying, oh, we can't sign a long-term LNG contract because we'll be net zero by then. We need to like work out our legal clarification to can we even do this with what we've signed for decarbonisation? And China's just saying like, hit the bid, give me all the LNG you can years from now. Like I think they sign 27-year deals with Qatar, and the same deal's going to go with uranium. Like China will just pay up. Like I've got a clip somewhere during the crisis. China was just saying secure at any price with LNG. They can just step in and pay whatever's necessary because they're trying to ensure their social stability, which is their like number one kind of priority. And with uranium, it's the best way to take advantage of that. And this is before you get to all the financial entities that are all going to trip over themselves squeezing it as well. So yeah, I couldn't be more bullish for uranium. I think it's all been recognized now. I had some of the, I think it was at WNA, one of the largest utilities, sort of standing up and saying like there is very limited sort of inventory, mobile inventory left. Like you better start talking to your producer, and that's just they're gonna eat their way up the cost curve, and then obviously there isn't enough there from producers ready, and then price will have to sort out the rest.
I don't know if you remember, but I've been interviewing people on uranium since like 2020, and I don't have any original thoughts, but I've seen a whole lot of people attacking my interviewees in 2020 and 2021 for like crazy price predictions, like 60, 70, and so on and so forth. It's kind of funny how it's all flipped, where we have very reasonable people, very successful people like Cuppy, for example, out there saying stuff like, I don't even know why people invest in anything else but uranium. And I'm sort of reminded, I pulled out a tweet of yours from 2021 in which you said that the uranium price is as likely to stop at 60 as a pendulum is likely to stop in the center of sort of mid swing. And sure enough, you're right. It hasn't stopped at 60 right now. And I mean, if 60 is the mid swing of sort of the equilibrium position of a pendulum, what's the what do they call it? The massive bob? What's sort of the full extent of that pendulum swing, in your opinion?
I don't know. Like I don't even want to sort of put a price on it, but I always like the idea of. I think it always you get laughed out of the room if you say where it'll eventually end up. You get laughed out of the room if you were to actually name it now. It's similar to going back before like negative interest rates happened. If you'd forecast forward and said that European like Greek bonds would trade negative, like you would have got laughed out of the room like before it actually happened. Like you would have if you told someone before the whole crypto boom happened that there would be a joke dog coin that would achieve an $80 billion market cap, you would have got laughed out of the room. And so all I know is that I think uranium will do something silly because it's essential to like it's easy, unlike a joke dog coin, it's easy to say why you have to pay up for it to keep a multi-billion-dollar reactor running. Where that price will be, I have no idea. I'm going to scale out according to like a plan. I'll miss it by a mile. I'll be fully out of it by the time it probably does something really crazy. And that's just my process. I'll just have to cry and imagine how much I could have made if I top ticked it, even though I know I can't. And it's really that simple. And the other thing is to know that I've got no idea what those dollars are worth. Like if uranium does sort of $500 a pound, what will that dollar be worth? It's another few years, and inflation's really running hot in the teens, and that's kind of important as well. As it could be quite a debased currency. It's kind of like if you're, I don't know, quoting your returns in sort of Argentine pesos or something. Like it's kind of you've done great nominal returns, but what are your real returns as well?
I want to ask my guests to express their uranium price prediction in the bread to uranium ratio. There's always these crazy ratios that people make. I saw a ratio of price of iPhone to gold or something along those lines. Someone was making the case that therefore gold should go. It's just always these ratios. But you do make a good point, though. I mean, if a loaf of bread is $50 and uranium's 500, could it be? Yeah, why not? It is depend. Good point. Yeah, interesting to think about. Let's
price
go ahead.
predictions aren't very helpful. Like, it's just
No.
trying to think in terms of like what anything will achieve nominally. You're far better off like keeping your focus on what the crowd's doing and trying to understand sort of market sentiment, like trying to have some cold hard rules to start scaling. Like, the only way you get out of these hyper cyclical markets is gradual scaling, and just having like, it can be silly stuff that gets you out, but as long as you're scaling gradually and you understand that there is no way in hell that you'll top tick this. There's just not the liquidity. It's just not the way it works. I've always described it as like kind of being in a packed super pack, like kind of you can watch the whole game, also get to the car park first. It's just never going to happen. You're going to have to leave the game early. You're going to have to miss some of the fun, but that's the only way you exit and you get home like on time, like safely. Like, that's just the way it works. Everyone thinks they can watch the whole game and leave at the same time, and it just doesn't work that way. It's not how markets work.
So you're basically telling me to avoid the monkey trap.
Yep, exactly that.
When was that article written? Let me check. I have it up on my screen here. July 27, 2020. So over 3 years ago.
Yeah.
Everything still implies?
Yeah, I'd lift a lot of the prices. I think seeing cost inflation run pretty hot across the likes of, we've seen sort of 30-40% cost inflation across the likes of Kazatomprom, Paladin. I think probably add at least sort of $20 a pound on some of those predictions minimum. And that's just the fact that it took a lot longer to play out, and there's been far less has been done, and we've seen more financial players. We've seen more polarization between East and West, and I think all of that, price is going to have to resolve it.
You had someone tweeted something about it on Twitter. I don't remember exactly who it was, but it was someone basically giving a couple of arguments against that. I think you saw it because you retweeted it as well. Do you know what I'm talking about?
Yeah, well, I think he misunderstood and kind of apologized, because he took that tweet was from 2020 as well. And someone had just retweeted it onto his feed, and he said, "I saw Ferg say this today." And I was like, I haven't said anything about uranium exiting for years now. And so that was a bit of a misunderstanding. So, but I also, he made some good points, but I sort of disagree with some points. Sort of, you can't compare it to crypto, or I was comparing it to, we've seen this sort of euphoria stage with crypto, like how people act, how it's all they want to talk about. Like, if you kind of understand that, like, one of the first things my mentor drilled into me was John Templeton's quote that bull markets are born in pessimism, mature in skepticism. How was it? No, bull markets are born in pessimism, grow in skepticism, mature in optimism, and die in euphoria.
Right.
And that's very sort of like airy fairy. Like, how do you know when you move from optimism to euphoria? Or having seen like a full cycle of people just going crazy, like the laser eyes and all of it, like, you kind of know what like extreme euphoria looks like. And so that's why I was using the crypto as kind of an overlay for knowing when people just go, what euphoria looks like in an asset market. And you shouldn't be there for any of it. Like, if there's people running around on Twitter with green eyes, calling themselves like uranium, they've come up some term, you just don't want to be anywhere near that. That's where I think coal could be fantastic as kind of a rebalancing vehicle. You just you'll get out early. You'll miss a lot of the absolute craziness. Or if you do want to partake in the craziness, just do it with the last sort of 10% of your original position. Try and pick the top of the last 5-10%. Like, pat your ego with that, but have got the vast majority across to something where you'll grind out returns and really set yourself up. Like after every epic bull market, there's always a room full of people that can tell you how much they were worth on paper at some point in time. Just don't be one of them.
The scene from The Gambler on the FU money comes to mind when
That's
people talk about that. Awesome scene, but
exactly.
it's very well said, and I understand that. But am I really going to be able to do that in real life? Because the whole theory is
Oh
that
yeah,
when you sit on a gambling table, you get up when you have the FU money and you do whatever the man says in there. But am I actually going to be able to do that? I think it's easier said than done. So I don't know.
100%. Well, you've got my favorite example, which people are probably tired of hearing me say, was Stanley Druckenmiller, and he is, I don't even know if it's that debatable, one of the best sort of traders of like the last period, and he got out early with some profits in the tech and the .com, and just watched it go higher. And in the end, he couldn't help himself as he kept two young traders on that were trading it, making money hand over fist, and couldn't stand it and got back in only a month or through from the top and dusted a few billion. And so if someone that's as cold-blooded and calculated as him, who are we to think us sort of retail sitting in our undies, we can time a top or we can understand how to trade out of a market? And so that's why I think you have to really put the plan down on paper and do your best to just scale slowly. That's the only way you get out of this. Yeah, to think you'll make a binary decision and say one day isn't it, that's it, I'll get out. You'll never do that, because then you'll keep checking the markets and you'll be sort of calculating the gains in your head, and then that'll encourage you to get back in, and then you'll just make terrible decisions. You'll be running on emotion. And so it's something that's quite interesting that happens if you do scale out, but you still have money in the market. You still feel like you're doing well, and you're still realizing gains, and it kind of stops you having that kind of emotional short circuit as much. And so that's why I always sort of, the only way that you deal with a really parabolic bull market like that is just taking chunks off quite religiously.
Have you done that with any commodity recently that you can remember? It's like, oh, that worked well for me, and that's exactly what I did.
No, honestly, I haven't really. Oh no, that's not true. I have scaled out of some stuff, but it was mainly because I saw something that had more relative value. So that's another way you can get out far quicker, is if something was like this example. I had some big positions in some companies from around the COVID smash. It was Ontario Energy was one of them, and then I saw Peabody, and I really liked the setup of Peabody, and I felt like Ontario was kind of risky. I didn't know how much higher it had to run, and so the relative value was such a big gap. I was like, okay, I'm moving that across. So that can occur when there's just, you think something's just got silly, you can't really justify it, and there's something that's super attractive, then you can move across. This is how my mentor sort of sees it playing out. There'll be a point at which the valuation gap will get too big, and you'll just be like, all right, I'm not comfortable playing this anymore. And you'll get uncomfortable with the size of it in your portfolio as well. Something that doesn't get talked about often enough is just how it turns you into a sort of a emotional basket case, having positions like 10x on you. Like it invariably becomes a big part of your portfolio, and then drawdowns hurt. You become more sort of emotionally charged with the size of it. I've got at the moment with some of my uranium positions. They've one in particular is larger than my whole portfolio when I put it on. It's run that much, and so invariably that dials up the volatility of my whole portfolio considerably.
Trying to find a quote that I'm failing at, because it was something along the lines of, what every day you own a stock is like you're buying it again, as in, thinking about risk adjusted rewards in relative sense. So what's the risk adjusted reward to that given uranium stock relative to, let's say a risk adjusted reward on a coal stock, as in what's the upside versus the downside on each one of those? And so every day you stay invested in something, is as if you're giving yourself a confirmation of, okay, I still think that the risk reward, or the risk adjusted reward actually, is better in this than it is in everything else. And that's
Yeah.
one way to think about exiting, I think. That's pretty much what you're saying here.
Yeah, I think I forget which investor said it. He's like every day you've got to pretend your portfolio is starting in cash. But
Mm,
then yeah, that also it's kind of a good exercise to go through, but it also doesn't really play out in reality with
mm,
you get chopped up on taxes. It's also there's a lot to be said for just buying something and trying to leave it alone. Like a lot of this is just the gains you'd make by just getting involved in a sector and then not overthinking it. Like I see so many people, even currently with uranium, like they're coming up with their DCF and they're explaining how this no longer makes sense and get out. And it's if that was always their process and there's something equally attractive to go into, then good on them. But if you're just kind of talking yourself into taking a profit, then that usually hurts you as well in the long term, which is why having the exit plan is just so key.
mm. You so for everybody listening, you have this weekly newsletter. It's free. You call it Ferg's Finds, I believe.
Yep.
So people can go to, what is it, traderferg.com, I believe. Traderferg.substack.com. I think that's also one
Yeah,
way to
yeah,
subscribe
yeah.
to it. And
Mm.
so in it this week you shared a podcast in which the guy was talking, was it this week or at least the week before? I don't remember. I read them. And you shared a podcast in which the guy was talking about, playing the AI boom with Nvidia right now. It's sort of like playing the .com boom with Cisco, something along those
Yeah.
lines. What do you think is the Cisco of the energy sector right now?
That's a good question. Let's go to the energy sector. Um, when you talk about, yeah, so with Cisco, I know that was one that went from, was obviously had very high expectations. They said they were going to be the backbone of the internet. They said they're going to do double digit revenue growth for the next decade. They did all of it and they got smashed like sort of 80 odd, 86%, I think, from the top of the dot-com boom. So if I was over that with energy, I'd say it would have to be some green energy play that's been propped right up. An easy call would have been one of the wind turbine makers, whether it's Vertas or Siemens Energy, but they've already kind of been cut in half. I did have a short um, a year or so ago on some of the US utilities. I think they've just leveraged themselves up and put a whole lot of green energy. None of it makes sense, and so I think they all just get smashed on the back of just multiples constantly compressing, and they just lose money in a higher interest rate, energy scarce world. Whereas yeah, there's no multiple compression to happen in coal or anything. Sort of 1-2 times free cash flow. Yeah, can't compress that too much.
Mm.
So yeah, that would be my take, I guess.
Okay, well, good point. It's something that I was also thinking about for a while. What do you think? When you look at the risk reward on uranium, where the risk reward of uranium was in 2020, and you look at it where it is today, it's no longer constructed in the same way. I'm not going to say that it's less upside or more risk, because it's not, and the thesis has changed a whole lot with more growth on the demand side and more issues on the supply side. But what do you think today is what uranium was in 2020? Like, is there a certain commodity that, I remember you were into rare earths again two years ago. I know you like tin, but there's not really many options to play that. But is there another commodity that you think is today where uranium was in 2020?
No, most of them honestly sort of left the station. There's ones that have only recently left the station. Like I think uranium, you kind of, if you only look at it now, you've missed it really. It's the asymmetries nowhere near what it was. Like a lot of the plays
Hmm.
are already sort of 10 baggers. Um, Probably the one that's most recently left the station would still be sort of the offshore oil plays. I think that's still probably quite attractive. Some of the coal plays are still, especially now with they've been really hammered with a lot of the coal prices rolling over. So yeah, between coal and offshore, I think that's probably where the most value is right now. And some of the shippers. I was just looking through trying to wrap my head around some of the shipping stocks, whether it's tankers, whether it's dry bulk. Trying to, some of those charts look really nice. I just need to understand the markets. I've kind of taken my finger off the pulse for a while, so I'm trying to get up to speed with them again.
Okay. Okay. I think we've gone through a whole lot. I don't want to keep you throughout your entire evening there. Have you like what do you think? I guess this sort of be one last question before we go into the last segment here. But what do you do if some of these things don't work out? Like they do sound like no-brainers, but every has that its risks to it. There's a lot of unexpected things that can happen. There's black swan events, like it could be a nuclear accident, I suppose. How would you deal with that in terms of how would you exit cutting your losses?
Yeah, well, inherently how I've set up my portfolio, some of it hedges other sides. So if nuclear is a total flop, then that amount of future energy needs to be created somehow, and so that'll directly benefit coal. So coal probably takes up the slack, and like the other way around, if nuclear defies all expectations and China keeps pumping out reactors sub 3 billion, does them, it gets them down to knocking them out sub 6 years, and then that's obviously quite bearish coal if we have a massive build out of, and so there is this kind of a hedging function with that. With oil, there's just nothing else. Like I don't buy that EVs are going to even put a dent in oil demand for decades to come. Like you just have to run through the breakdown of where a barrel of oil ends up. It's passenger vehicles are less than a third. You've got diesel demand keeps growing. You've got the plastic demand. You've got all the chemicals. You've got jet fuel. You've got everything. Nothing, and so quite confident in that. But as for actually like pulling the pin on a sector, it would be hard. That's one of my main. Like I think Brad always taught me, he was like, know what your flaw is as a trader when you start. My biggest flaw as a trader is I do a lot of research and then I hold on for dear life through thick and thin. Like I stomach a lot of volatility. I'll almost more put my head in the sand and not put my head in the sand, but kind of hold through crazy volatility if I think I'm still right. And that's like a terrible attribute to have if you're trying to run stop losses and do forex trading. Like I'd go bust in no time if I was trading futures or forex. Like it's just not suited to my personality. But the way I trade, going into hated sectors, doing a lot of research, getting a lot of conviction so I can hold through volatility, and then also being quite objective. Like if I had a clear thesis and that's not playing out, then I'll be quick to cut. And more recently, I've been quick just to cut. I don't have to sound smart for why I'm cutting as well. If something keeps lagging, good news comes out sector, all my other positions go up 5%, this one thing does nothing, then that's enough of a reason. So I've come to grips with that a bit more. I felt like I used to sort of over intellectualize a lot of my exits for a while, and now I've just been a bit more simple with it.
It's very funny you should say that, because that's I over intellectualized my portfolio in 2020, but it doesn't help not being intellectually versed while doing that, because I lost a whole lot of money, and it taught me a lesson to is maybe over intellectualizing in general. Maybe it's just not a thing for me. So it's a good point, and it hits close to home. I have started ending my episode sort of with a game show type of question where I will I'm gonna roll a dice. It's a D20 dice, so there's 20 sides to it. I'm gonna roll it on Google, so I'm gonna record the screen. It's gonna come out with a number, and that number is gonna correspond to a question that I have in a list over here in my computer. And you're gonna basically have to answer that question and not back out of it. Is that okay?
Mm-hmm.
Okay, let's go.
Go for it. Yeah.
Let's see. I'm gonna roll, and it comes out as a 7. That's very original. Let's see. What is the most contrarian natural resource play at the moment? Sector R stock. I think that's pretty much exactly what we talked about. But out of those three, I suppose, if you had to rank one the highest, which one would it be?
I think I'd be most scared going into right now would be shipbuilding. I think that would be the absolute contrarian of the contrarian.
Okay.
Yeah.
Okay. Let's go for a third one. We're going to do 3. just again to be original. And next one is 3. Okay, that's super original this time. Okay. What's the size of your natural resource portfolio relative to your net worth? Like if you count up everything, car, house, everything, what part of everything that you own is in the natural resource space?
All of it, bar the house and the car. Yeah.
Okay.
So yeah, probably 90, 98% of my net worth. Yeah.
Wow, that's conviction.
Mm.
Okay. Well, but you
Yeah.
also live
Between
in Bali,
coal,
so I
uranium.
suppose I don't know how housing's there, but that also may be okay. Yeah. Wow.
Mm.
Let's do a third one. What is this going to be? 13? No, it's 15. Okay, let's see. Going to 15. Technical analysis versus fundamental analysis, or both?
Fundamental all day long. But some technicals help to screen out. Like I love looking for sort of breakouts, charts that are bucking a trend. So yeah, 95% fundamentals, 5% technicals.
What do you do when it comes down to technicals? Is it an RSI type of thing?
No, I love Koifin. Like I think everyone should have a play on that. The free version's amazing. I've used it for years, and I've got this thing called Sparkline Graphs. So if you kind of scan for a basket of stocks, you can bring up this tiny little chart, and you can just go through a sector and see like who's been sort of bucking a trend, performing, and it's just a wonderful function.
How do
And so
you what's that called?
Koifin,
Okay.
K O Koyfin, and
Okay.
then yeah, you can run kind of a search function globally, which is fantastic. It's got a really good scanner, and you can
Oh,
say if you were wanting to look at I don't know, tanker stocks, you can just scan that way.
is that free?
Yeah,
Is
so
that this is basically
yeah,
a
yeah, that's
trading
free.
view alternative, right? But then
Yeah, it's
better,
got
I
far
suppose.
more data.
Okay.
Yeah, yeah, my dog's coming to try and encourage
Yeah,
me to go
nice.
for a walk.
It seems like it's it seems like it's a free there's a free option, $0 a month. I like things that cost $0. All right, Ferg. Was a whole lot of fun. Yeah, again, I see your dog's no longer liking me. You can go ahead and have some fun.
He's
Yeah, thank
good.
you so much for
Yeah,
doing
there we
this.
go.
Awesome. Yeah, I mean, he's giving you
No, it's a
suggestions.
pleasure. Thank you for having me back on.
Pleasure's pleasure's all mine. All right, thanks a lot for doing this.